It was a hack. Something crazy will happen. When markets open, CME reporting goes offline. The world's largest financial exchange, silent. $4 trillion in daily transactions, vanished into digital darkness. Weekend systems that never fail, failed. Reports that always publish, missing. Gold markets that just survived their most violent week in history. Now face Monday with no data, no confirmation, no truth. Someone turned off the lights, and when they come back on, everything changes. Welcome to Global Finance Revealed. If you've been watching the markets long enough to remember when trades were written on paper, when a handshake meant something, when the systems were simpler but somehow more honest, then you understand why what happened this weekend matters. This channel exists for those who remember, for those who built businesses before algorithms took over, for those who understand that behind every screen, every data point, every digital transaction, there are real consequences. If that's you, if you're someone who values clarity in an increasingly complex financial world, take a moment and subscribe to this channel, not because it's trendy, because it's necessary. And tell us, where are you watching this from? Which corner of the world are you monitoring these markets from today? Drop your location in the comments. Let's see how global this crisis really is. Now, let's talk about what happened while the world was sleeping. The discovery came quietly, too quietly for something that would shake the foundation of global finance. It was Saturday, February 1st, 2025. Markets were closed. Trading floors across Chicago, New York, and London sat empty. This was supposed to be the calm period, the time when the machines reconciled what the humans had done during the week. But the machines had stopped talking. Analysts monitoring the CME Group's public data feeds noticed it first. The daily reports that always appeared like clockwork weren't appearing. The delivery notices that documented physical metal movements showed nothing. The issues and stops data that confirmed who actually took possession of gold, silver, copper, all blank. At first, it seemed like a minor technical glitch. Then the timestamps were checked. The last successful data publication had occurred at 4:47 p.m. Central Time on Friday. Since then, silence. Not an error message, not a delay notification, just absence. The CME Group is not a small operation. It is the largest derivatives marketplace on the planet. Every day, it processes over $4 trillion in notional value across futures and options contracts. It handles everything from crude oil to treasury bonds, from corn to currency swaps. But its most critical function happens on weekends. When markets close on Friday afternoon, the real work begins. Clearinghouses activate their batch processing systems. They reconcile every trade. They match every buyer with every seller. They calculate margin requirements. They process delivery requests. They move actual physical commodities from warehouse to warehouse. This weekend reconciliation is the backbone of market integrity. It's how the financial system knows who owns what. It's how trust is maintained in a world of paper contracts representing real assets. And this weekend, that backbone fractured. The missing data wasn't trivial. It represented the settlement layer of the entire derivatives market. Without it, participants couldn't confirm their positions. Banks couldn't verify their exposure. Regulators couldn't monitor systemic risk. Most importantly, no one could confirm physical deliveries. This mattered because the previous week had been extraordinary. Gold futures had experienced their most volatile trading period in recorded history. Prices had swung by hundreds of dollars per ounce within single trading sessions. Volume had exploded to levels not seen since the 2008 financial crisis. And open interest, the number of contracts still active and awaiting settlement, had reached unprecedented levels. Thousands of contracts were scheduled for physical delivery. Real gold bars, real silver, real metal that had to move from COMEX warehouses in New York and Delaware to the vaults of banks and institutions around the world. But now, there was no record of that movement. The delivery notices that should have documented every ounce, missing. The warehouse receipts that should have tracked every transfer, unavailable. The issues and stops report that should have confirmed every transaction, blank. Market observers began making calls, first to colleagues, then to contacts inside the CME, then to clearing members, then to regulators. The responses were careful, too careful. We're aware of a reporting delay. Systems are undergoing maintenance. Data will be available shortly. But hours passed, then more hours. Saturday afternoon became Saturday evening. Evening became night. The data never came. By Sunday morning, a different conversation was happening. Not about technical glitches, about something darker. The CME's systems are built with redundancy, multiple backup servers, failover protocols. Disaster recovery procedures tested quarterly. The probability of a complete reporting blackout lasting more than 2 hours, statistically negligible. Yet here it was, approaching 36 hours. Two possibilities emerged. First, the system had been overwhelmed. The volume of delivery requests, the complexity of settlement calculations, the sheer mass of data had exceeded the infrastructure's capacity. The machines had choked on their own workload. Second, someone had deliberately shut it down. The hack hypothesis gained traction quickly, not because there was evidence, because the alternative was worse. A system failure implied fragility, implied that the infrastructure couldn't handle stress, implied that the next crisis might break it permanently. A hack implied malice, but malice could be fixed. Fragility, that was structural. By Sunday afternoon, the financial community faced an uncomfortable reality. In less than 24 hours, markets would open, traders would return to their desks, algorithms would activate, orders would flow, prices would move. But the foundation, the clearing data that confirmed reality, would still be missing. Monday morning would begin with uncertainty. And in financial markets, uncertainty is the most expensive commodity of all. The question wasn't whether something would happen when markets opened. The question was, what? The CME Group's headquarters in Chicago houses something most people never think about. A machine that never blinks, 24 hours a day, 7 days a week. The system processes the financial heartbeat of the Western world. It matches buyers with sellers. It calculates risk. It moves money between accounts at the speed of light. It transforms abstract agreements into binding obligations. And for the first time in its digital history, it had gone silent. To understand why this silence mattered, one must first understand what the CME actually does. Most people think of it as a trading platform, a place where speculators bet on the future price of oil or wheat or gold. That's partially true, but it's like describing a hospital as a place where people wait in rooms. Technically accurate, fundamentally incomplete. The CME is a clearinghouse. This distinction is critical. When a trader buys a gold futures contract, they're not actually buying gold. They're entering into an agreement, a promise. They promise to accept delivery of 100 ounces of gold at a specific price on a specific date. Someone else promises to deliver it. But these two people never meet. They don't know each other's names. They don't exchange phone numbers or sign documents in the same room. Between them sits the CME. The exchange becomes the buyer to every seller and the seller to every buyer. It guarantees both sides of every transaction. If the seller disappears, the CME must still deliver the gold. If the buyer vanishes, the CME must still accept it. This is called novation, and it's why the global financial system works. But novation creates a problem, a massive, complex, dangerous problem. The CME now sits in the middle of millions of obligations. It owes gold to thousands of buyers. It's owed gold by thousands of sellers. It owes cash. It's owed cash. Every second, these obligations shift as prices move and positions change. To manage this risk, the CME built something extraordinary, a digital architecture called Clearing 21. The system tracks every open contract. It calculates the market value of every position in real time. It monitors the collateral posted by every participant. It identifies which contracts are approaching expiration. It processes delivery intentions. It matches those who want physical metal with those who have physical metal to deliver. And every weekend it reconciles everything. The reconciliation process is not simple. It involves multiple interconnected systems working in precise sequence. First, the trading platform closes. No new positions can be opened. Existing positions are frozen at their Friday settlement price. Second, the delivery intention system activates. Participants who hold contracts expiring in the current month must declare their intentions. Do they want physical delivery, or will they roll their position into a future month, or close it entirely? These declarations flow into the matching engine. Third, the matching engine pairs delivery requests with delivery obligations. If Bank A wants to take delivery of 500 gold contracts, the system identifies which participants are obligated to deliver those contracts. It creates delivery notices, official documents that say, you will deliver X ounces of gold to Y location by Z date. Fourth, the warehouse system updates. Comexon operates a network of approved depositories, vaults in New York, Delaware, and other locations where physical metal sits waiting. When a delivery notice is issued, the system records which specific bars will move from which vault to which new owner. Fifth, the financial settlement occurs. The buyer's account is debited, the seller's account is credited. Margin requirements are adjusted, collateral is released or called. Finally, the reporting system publishes everything. Daily delivery notices, issues and stops, warehouse stock reports. This data becomes public record. It tells the world what actually happened. This entire process must complete before Monday's opening bell. Because when markets reopen, traders need to know their positions, banks need to know their exposure, regulators need to know systemic risk levels. Without this weekend reconciliation, the market opens blind. And that's exactly what was about to happen. The systems that should have been publishing data weren't. The reports that should have documented physical deliveries didn't exist. The confirmation that settlement had occurred properly was absent. Technical experts began analyzing what could cause such a failure. The CME's infrastructure includes multiple redundancy layers, primary servers in Chicago, backup servers in a separate facility outside the city, disaster recovery systems in a third geographic location. If the primary system fails, the backup activates automatically within seconds. For all three to fail simultaneously, that doesn't happen by accident, the data feeds themselves run on separate networks. Market data uses one pipeline, clearing data uses another, regulatory reporting uses a third. This separation is intentional. It prevents a single point of failure from taking down everything, yet everything was down. The timestamps told a strange story. The last successful publication occurred at 4:47 p.m. on Friday. But internal system logs, the ones that clearing members could access through private terminals, showed activity continuing until 6:23 p.m. Then, nothing. Not a crash, not an error code, just a clean stop, as if someone had simply turned off a switch. Cybersecurity analysts recognized the pattern. This wasn't a system overwhelmed by volume. Overwhelmed systems generate error messages. They slow down. They crash messily. They leave digital debris everywhere. This was clean, surgical, deliberate. Someone with deep knowledge of the CME's architecture had accessed the reporting layer and disabled it. Not the trading systems, not the clearing calculations, just the publication of results. The data existed somewhere. The reconciliation had probably completed. The delivery notices had likely been generated. The warehouse transfers had presumably been recorded. But no one outside the CME's inner systems could see any of it. This created a unique form of crisis. In a normal system failure, everyone knows there's a problem. Alarms sound, engineers mobilize, participants are notified, contingency plans activate. But here, the failure was invisible to most of the market. Casual observers wouldn't notice missing weekend reports. Only those who monitored the data feeds closely, analysts, auditors, forensic accountants, they saw the absence, which raised a disturbing question. If this was a hack, why target the reporting layer? Why not steal money directly? Why not manipulate prices? Why not crash the entire exchange? Unless the goal wasn't destruction, the goal was concealment. What if the reporting systems were disabled because someone didn't want the world to see what had happened during settlement? What if the delivery data would reveal something catastrophic? What if the numbers, the actual physical metal that moved versus the metal that was supposed to move, didn't match? Sunday evening arrived. Markets would open in less than 15 hours, and the financial world still had no idea what had settled and what hadn't. The architecture designed to create certainty had become a weapon of confusion, and someone, somewhere, knew exactly why. There are moments in financial history when multiple failures align, not sequentially, simultaneously. When the housing market collapsed in 2008, it didn't happen in isolation. It converged with a banking crisis, a derivatives crisis, a liquidity crisis, and a confidence crisis. Each one amplified the others. What should have been containable became catastrophic. Sunday evening, February 2nd, 2025, felt like that kind of moment. The CME reporting blackout wasn't occurring in a vacuum. It was occurring at the precise intersection of three separate crises that had been building for weeks, and nobody had connected them yet. The first crisis was visible to everyone. Gold prices had become unhinged. For decades, gold had traded within predictable ranges. Yes, it moved during geopolitical tensions. Yes, it spiked during inflation scares. But the movements followed patterns. Analysts could model them. Traders could anticipate them. Risk managers could hedge them. That predictability died in the last week of January. On Monday, January 27th, gold opened at $2,147 per ounce, a normal price, slightly elevated due to ongoing concerns about currency devaluation, but nothing alarming. By Tuesday afternoon, it had touched $3,120, a $273 move in 36 hours, not over months, not during a war or a currency collapse, just movement, violent, unexplained movement. Wednesday brought a reversal. Gold crashed to $2,690, then recovered to $2,150 by Thursday morning, then fell again to $2,780 by Friday's close. The volatility wasn't the strangest part. The volume was. Trading volume in gold futures had averaged around 350,000 contracts per day for the previous year. During that final week of January, volume exceeded 890,000 contracts on 3 separate days. Someone was moving enormous positions, fast. But the real anomaly appeared in the open interest data. Open interest measures how many contracts remain active, how many obligations are still outstanding, how many promises to deliver or accept gold haven't been closed yet. Normally, as a contract approaches expiration, open interest declines. Traders close their positions. Speculators exit. Only those who actually want physical metal, or those obligated to deliver it, remain. The February gold contract was set to expire on January 30th. By January 20th, open interest should have dropped below 10,000 contracts. Instead, it sat at 47,000 contracts, and it wasn't declining. This meant 47,000 contracts, representing 4.7 million ounces of gold, were potentially headed for physical delivery. At current prices, that was roughly $14 billion worth of metal that would need to move from COMEX warehouses to the accounts of contract holders. The second crisis was invisible to most observers. It was happening inside the warehouses themselves. COMEX operates a network of approved depositories. These are secure vaults operated by major banks and specialized storage companies. They hold the physical gold that backs the futures contracts. Every day, COMEX publishes warehouse stock reports. These reports show how much gold sits in each facility, how much is available for delivery, how much is already allocated to specific owners. In early January, total COMEX gold inventory stood at 21.4 million ounces. By January 29th, it had fallen to 18.1 million ounces. 3.3 million ounces had left the warehouses in 4 weeks. That's over 100 tons of gold. Gone. Withdrawn by owners who decided they wanted their metal somewhere else, or who needed to deliver it against obligations in other markets, or who simply didn't trust the system anymore. The withdrawals accelerated as the week progressed. On January 28th alone, 340,000 ounces left the system. This created a mathematical problem. If 47,000 contracts stood for delivery, that required 4.7 million ounces. But only 18.1 million ounces remained in the warehouses, and not all of that was available. Much of it was already allocated, already owned, already spoken for. The actual deliverable inventory, the gold that could be used to settle expiring contracts, was estimated at around 6.2 million ounces, enough to cover the delivery requests. Barely. But that assumed no additional withdrawals, no additional delivery demands from other contract months, no unexpected claims. It assumed everything went perfectly, and nothing was going perfectly. The third crisis was the most dangerous, and the least understood. It involved the clearing members themselves. The clearing members are the banks and financial institutions that hold accounts directly with the CME. They're the intermediaries between the exchange and the thousands of traders, hedge funds, and corporations that use the futures markets. When a trader wants to buy a gold contract, they don't deal with the CME directly. They go through a clearing member. The clearing member posts collateral with the CME on behalf of all their clients. They guarantee their clients' obligations. The system works beautifully until a clearing member fails. And there were signs that one of them was in trouble. The signs were subtle: a delay in margin calls being met, an unusual request to extend settlement deadlines, a quiet conversation between executives and regulators that wasn't supposed to become public. But in the small world of derivatives clearing, information travels. Whispers spread. Traders notice when a major bank's credit default swaps start widening, when their stock price weakens, when counterparties start asking for additional collateral before trading with them. By Sunday afternoon, 3 separate sources had mentioned the same name, a major European bank with significant exposure to precious metals derivatives. The bank's name wasn't being published, not yet, but the concern was real. If a clearing member failed, if they couldn't meet their delivery obligations, the CME would have to step in. The exchange would have to find the gold, buy it at market prices, deliver it to the contract holders, and if the CME couldn't find enough gold, if the physical metal didn't exist in sufficient quantities, the entire system would face something it had never faced before: a delivery default, not a trader defaulting, not a hedge fund blowing up, the exchange itself failing to deliver on its guarantee. This had never happened in the modern history of COMEX. Not during the 1980 silver crisis, not during the 2008 financial collapse, not ever. The legal implications alone were staggering. Thousands of contracts, billions in notional value, lawsuits that would take decades to resolve. But the market implications were worse. If COMEX couldn't deliver physical gold, if the paper contracts turned out to be unbacked promises, confidence in the entire futures market would evaporate. Not just gold, everything: oil, wheat, treasury bonds, currency swaps. The futures market exists because participants trust the clearinghouse, trust that contracts will be honored, trust that delivery will occur when demanded. Break that trust, and the system collapses. Now, these 3 crises were converging: extreme price volatility, abnormal delivery demands, declining warehouse inventories, a potentially failing clearing member, and in the middle of it all, a reporting blackout that prevented anyone from seeing what had actually happened during settlement. The timing was too perfect, too precise. If the delivery data showed that settlement had failed, if the numbers revealed that gold couldn't be delivered, if the reports documented a clearing member default, that information would trigger panic when markets opened Monday. But if that information stayed hidden, if the blackout continued just long enough, maybe positions could be unwound quietly. Maybe emergency liquidity could be arranged. Maybe the crisis could be managed behind closed doors. Or maybe the blackout was hiding something even worse. Sunday night deepened. Across time zones, traders prepared for Monday's open. Risk managers reviewed their exposure. Executives gamed out scenarios. And somewhere in Chicago, inside the CME's operations center, people who knew the truth were making decisions. Decisions about what to reveal, what to conceal, how to manage the convergence. In 14 hours, the markets would open, and the world would discover whether the system had survived the weekend or whether it had quietly broken, and nobody had been allowed to see. Monday morning arrives, whether the world is ready or not. February 3rd, 2025, 8:20 a.m. Eastern Time, 40 minutes until the New York markets open. Trading desks across lower Manhattan are fully staffed. Screens glow with pre-market data. Coffee sits untouched. Conversations are quieter than usual. Everyone is waiting for the same thing, the CME data feed. The weekend reports that should have published 36 hours ago, the delivery notices, the settlement confirmations, the warehouse stock updates. At 8:31 a.m., the CME issues a statement. Due to scheduled system maintenance, certain reporting functions experienced delays over the weekend. All clearing and settlement operations completed successfully. Standard reporting will resume during today's trading session. Market participants can trade with full confidence in the integrity of all cleared positions. 147 words, carefully constructed, legally precise, and completely insufficient. The statement confirms nothing. It provides no data. It doesn't explain why backup systems failed. It doesn't address the 36-hour blackout. It doesn't publish the missing delivery numbers. It simply declares that everything is fine and expects the market to believe it. Within minutes, analysis begins. The phrase scheduled system maintenance is immediately questioned. If the maintenance was scheduled, why was no advance notice given? Why did it coincide with the most volatile week in gold market history? Why did all redundant systems fail simultaneously? The claim that all clearing and settlement operations completed successfully raises more questions than it answers. Completed? How? With what results? How many contracts stood for delivery? How much physical gold actually moved? Which clearing members took delivery? Which ones made delivery? Without data, the statement is just words. And markets don't trade on words. They trade on information. At 8:47 a.m., the first cracks appear. A mid-sized hedge fund in Connecticut sends an urgent message to its prime broker. They hold 200 gold contracts that were supposed to settle on Friday. They posted the required cash. They submitted delivery instructions. They expected warehouse receipts confirming ownership of physical gold. They received nothing. No receipts, no confirmation, no communication from their clearing member. The prime broker contacts the CME. The response is vague. Settlement processing is ongoing. Documentation will be provided shortly. But shortly is not acceptable when markets open in 13 minutes. The hedge fund faces a decision. Do they assume their delivery succeeded and adjust their portfolio accordingly? Do they assume it failed and maintain their hedges? Do they enter new positions to protect against unknown exposure? They cannot make rational decisions without information. And they are not alone. Across the financial system, dozens of institutions face the same problem. They have positions that should have settled, obligations that should have been fulfilled, deliveries that should have occurred. But they have no confirmation, no data, no certainty. This is not a technical problem. This is a strategic crisis. Because modern financial markets operate on a principle that most people never consider: information symmetry. When a market opens, all participants are supposed to have access to the same basic facts, the same prices, the same volume data, the same settlement information. This creates fair competition. It allows rational decision-making. It enables price discovery. But Monday morning's opening will not have information symmetry. Some participants, those inside the CME's clearing operations, those at major banks with direct access to internal systems, they know what happened over the weekend. They know which deliveries succeeded, which ones failed, where the gold actually is. Others, smaller institutions, independent traders, foreign participants, they know nothing. This creates an environment where informed players can exploit uninformed ones, where those with data can trade against those without it, where the market becomes a mechanism for wealth transfer rather than price discovery. At 9 a.m., the opening bell rings. Gold futures begin trading immediately. The February contract, the one that should have expired and settled, shows minimal activity. Most positions have been closed or rolled forward. But the April contract, 2 months out, opens with unusual volume. Within the first 60 seconds, 14,000 contracts trade. Prices spike upward. $2,780 becomes $2,840. Then $2,890. Someone is buying aggressively, large orders, market orders that accept any available price. This is not normal speculative activity. This is panic buying, or it's something else entirely. At 9:07 a.m., a pattern emerges. The aggressive buying is coming through 3 specific clearing members, all major international banks, all with significant precious metals operations. They're not buying for clients. They are buying for their own accounts. Why would banks suddenly need to acquire thousands of gold contracts at inflated prices? One explanation: they failed to deliver physical gold over the weekend. They are now scrambling to acquire contracts that they can settle in future months. They are rolling their obligations forward, buying time. Another explanation: they know something. The missing data revealed something that hasn't been made public yet, and they are positioning ahead of that information becoming widely known. Either way, their behavior confirms that the weekend settlement did not go smoothly. By 9:15 a.m., other market participants noticed the unusual activity. Questions flood trading desks. Risk managers demand explanations. Compliance officers start making calls. The CME issues a second statement at 9:23 a.m. A small number of delivery transactions from the February gold contract are being processed through standard exception procedures. This is routine and does not indicate any systemic issues. All affected parties are being contacted directly. The word exception is critical. In clearing operations, an exception means something didn't process normally. A delivery that should have been automatic required manual intervention. A transaction that should have cleared through standard systems needed special handling. Exceptions are not routine. They are failures that require workarounds. And the CME just admitted they exist. The market reacts immediately. Gold prices accelerate upward. $2,190 becomes $2,950, then $3,020. But this is not a rally driven by fundamental demand. This is a liquidity crisis. This is participants realizing that physical gold might be harder to obtain than the paper contracts suggest. The divergence between paper and physical, the gap between contracts and actual metal, is becoming visible. At 9:41 a.m., the first margin call goes out. A regional bank in Texas receives notice from its clearing member. Due to increased volatility and position concentration, additional collateral is required. The amount, $340 million to the deadline, end of business today. The bank doesn't have $340 million in liquid assets readily available. They will need to sell positions, liquidate holdings, possibly borrow from the Federal Reserve's discount window. This is how contagion spreads. One institution's problem becomes another's. Forced selling creates price pressure. Price pressure triggers more margin calls. More margin calls force more selling. By 10 a.m., the situation has evolved beyond a data reporting issue. This is now a crisis of confidence in the clearing system itself. Institutional investors begin asking fundamental questions. If the CME cannot publish basic settlement data on time, if delivery exceptions are occurring, if major banks are panic buying contracts, can the system be trusted? Should positions be reduced? Should exposure to futures markets be cut entirely? Should physical metal be withdrawn from COMEX warehouses before it becomes inaccessible? These questions lead to actions, and actions create feedback loops. At 10:17 a.m., COMEX warehouse data finally updates. The numbers show what happened over the weekend. Total inventory, 17.4 million ounces, down from 18.1 million on Friday. Another 700,000 ounces withdrawn in 2 days. But the delivery data, the information showing how many contracts actually settled, remains unpublished. The asymmetry is deliberate. The CME is releasing some information while withholding the most critical details. This is crisis management, controlled disclosure, revealing enough to prevent panic while concealing enough to prevent catastrophe. But it's not working. By 11 a.m., gold has touched $380 per ounce. A $400 move in 2 hours. Silver is up 12%, platinum up 8%, copper up 6%. The entire precious metals complex is surging, not because of economic data, not because of geopolitical events, because trust in the paper market is evaporating. And then, at 11:34 a.m., the information finally leaks. A Bloomberg terminal flashes a headline. Source: Major European bank failed to deliver on 4,200 gold contracts Friday. The name isn't published, but the number is specific enough to be credible. 4,200 contracts, 420,000 ounces of gold. At current prices, roughly $1.3 billion worth of metal that was promised but not delivered. The market had suspected. Now it knows. A clearing member at a major bank defaulted on physical delivery, and the CME had tried to hide it. What happens next will determine whether this remains a contained crisis or becomes a systemic collapse. Because the question is no longer whether the hack occurred. The question is whether the system can survive the truth.